The US inflation rate came in today at 3.2%, which was slightly higher than what the Federal Reserve was aiming for this month. Nonetheless, we can see that companies in the S&P 500, the majority are all turning green, up at least 1 to 3 percentage points, which makes it harder and harder to find some strong, cheap dividend stocks to buy. Nonetheless, in today's episode, we're taking a look at 4 cheap stocks that we believe to be a very strong buy now. As always, we'll look at their historical performance, we'll run through their dividend safety, we'll look at their financial metrics, and as always, we'll put them through the valuation model, getting to our intrinsic value, looking at that acceptable buy price, using our investor margin of safety, and seeing what Wall Street are forecasting for the next 12 months. So the first company we are looking at today is PCOM Software. Now this is one that is down 32% over the last year. We can see it pretty much towards its 52-week lows. It does have a yield just under 1%, and we can see the forward P at just under 24. If this is one you've been holding, well, over the last 10 years, we can see its price did peak at around $550. So right now it is quite some way away from that all-time high price. In terms of dividend safety, it's just started paying a dividend, so we don't have the score yet. Market cap is sitting at just over 10 billion. It is a large cap company. And when we take a look at that free cash flow payout, even though it's the first year they're paying a dividend, 2023 is coming in at 23%, which is pretty low, very positive. We ideally want to see below 60%, and 2024 is expected to increase very slightly. So even though they have just started paying a dividend, I would expect double-digit dividend increases. Free cash flow per share, very, very strong. This has increased from 16 cents in 2014 to $4.99 in 2023. Strong growth over the last 10 years. On top of that, it is expected to increase again to $5.25 in 2024. When we take a look at the sales growth, we can see double-digit growth every single year. Very, very strong. Not only that, but it is continuing that 2023 at 23%. And on the trailing 12 months, we're seeing 23% as well. So it doesn't look like the growth to the top line of PCOM Software is going to be stopping anytime soon. In terms of numericals, well, 150 million in sales in 2014. 1.69 billion in 2023. As we said, they are growing their top line at a very rapid rate. And even though we don't like it when companies issue shares diluting your position, we can see over the long term, it is a very small increase from around 52 million to 58. In terms of the ROIC, now this is a very, very strong metric for me. I want to see 10% or more to give me faith that management are able to effectively allocate their capital. And what we can see here is double digit every single year, and in fact it has been increasing over the longer term. 30% in 2023 is a very strong metric and something you should not look away from. Very strong. Operating margin, well, again, they have improved their operational efficiencies. 10% in 2014, 27% in 2023. Ideally, we want to see a minimum of 12%. So the fact that it has increased from a fairly decent starting point at 10% to around the high 20s, that is a strong factor of why we have included this company today. On top of that, their free cash flow margins have been improving over the last 10 years. And again, we do want to see a minimum of 5%. So the fact in 2014 we see 6% and it has been increasing over the longer term. These are some very good numbers for this company that has just started to pay a dividend. And one of the best metrics, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, gives us faith that the balance sheet is very strong and the dividend is very safe due to the fact that over the last 5 years and in 2024 expected, these numbers are going to be zero, which shows that it wouldn't even take them 1 day to pay off all of their debt net of cash on hand. Absolutely phenomenal. Now, in terms of the valuation for PAYC, let's take a very quick look. Now, what we typically do on this channel is deep dives running into every single one of these models. Today's episode, we're going to get straight into it for the intrinsic value, which is the average of these two models that you can see on screen, coming to $235 for today's episode. Now, with the current price at $186, we always start off with a margin of safety of 10%. Remember, we use that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If we believe that, it's a buy up to $211. We keep going till it's near the current trading price, and we can see it is pretty much giving us a MOS level of 20% based on the estimates and judgments we've used today. In terms of Wall Street, well, they believe over the next 12 months, this price is going to go higher than our intrinsic value. They see upside of 29%, giving this a very strong buy rating. But as always, I am keen to know your thoughts based on the metrics we've run through and whether or not these companies we are going through today are ones that you are adding or have even added over the last few months. The next cheap stock that we are taking a look at is Chevron Corporation. Now, it is down around 4% over the last year. Over the last 10 years, however, it is up around 33%. Bear in mind that doesn't include those dividends reinvested. We do sit towards the mid to lower end of the 52-week range with a yield over 4% and a forward PE just about over 12. Now, in terms of the dividend safety, very safe, 90 score, market cap 282 billion, a mega cap company. Now, when we take a look at the recessionary metrics for the last recession, 07-09, well, they increased the dividend. They did have below average growth, negative 43 versus the S&P's negative 12, but they also outperformed the S&P with their negative 34% recession return. And as we can see here, the S&P returned negative 55. Dividend growth, well, they increased it just a few weeks ago, 7.9%, very strong, above that 4% we advocate to beat up inflation. 6% over the last 5 years, 7% over the last 20, looking very, very strong. And not only are they a dividend aristocrat, they have increased those dividends for the last 25 years or more. They have paid a dividend for the last 112 years without a reduction. So lots of positive metrics so far. In terms of dividend yield theory, well, we have a double sign of undervaluation. We have the 5-year average yield, 4.09%, below the current yield of 4.29. And we see, although marginally, the forward PE below the 5-year average. So you could argue signs of undervaluation / reasonable valuation based on these models. But as always, we never look at these in isolation and conclude towards the end. Energy sector PE is slightly higher as well at 13.2. Now, when we take a look at the free cash flow payout, which is what we want to do, below 40% for oil producers if you want to be industry specific, we can see over the last few years it has been below the 60% that I personally target. Hasn't quite got below the 40% if you do want to just look at oil producers as the industry. Although 57% in 2023, 53% in 2024, in my opinion, is a pretty positive sign, especially given we saw that 8% dividend increase. So I would be expecting a very similar increase next year. Free cash flow, well, we note 2014 to 2016. Again, bear in mind the cyclicality of the industry. It was negative. Since then, though, it has increased pretty positively in the right way. 1060 in 2023, 1240 in 2024 expected. So again, looking very positive over the next 12 months and beyond. In terms of sales growth, well, this is something that is just attributable to companies that are cyclical, negative over a few years followed by positive. We can see 2021 and 2022 was a very strong year, although 2023 double-digit negative to their top line hit, not looking great, but always imperative to understand with oil producers, with companies that are cyclical, try and look at them when they are out of favor, when people are selling them, and get them at those bargain basement prices. Total sales then, no surprises given the cyclicality, 192 billion in 2014, 195 in 2023, and we see the peaks and troughs over that 10-year period. Shares outstanding, they've done it all. They've done share buybacks. They've issued shares, as we can see year on year. Net position, though, they have bought back around 20 million worth of shares, so we do see it reduce slightly to 1.88 in the latest quarter. ROIC, I want to see 10%. Again, if you want to be industry specific, above 8% is sufficient. They hit that for the large part of the last 3 years, 13% in 2023, looking very strong. In terms of the operating side and the free cash flow side, pretty cyclical as we can see, although when we look at just over the last 3 years, they are looking very positive, and based on the metrics so far, there are no surprises. We should still be expecting this to continue. In terms of the net debt to EBITDA then, pretty low. I mean, 0.4 in 2023, below the 1.5. 2024 expected to go lower. So we can see for this company that has been paying dividends over 100 years, there are no real worries or any red flag indicators that have popped up today. In terms of the intrinsic value, then it is just the average of the models that you see on screen. And for today's episode, $180. We can see now 151 versus the 179. So in terms of that margin of safety, 10% up to 162, 15% pretty much around $1 away from the current trading price. So again, depending on what margin of safety you are looking for, this will be dependent on the companies, the industries, maybe the macroeconomic factors and any headwinds for that particular industry. We are saying it does have a 15% MOS level. In terms of Wall Street, $177 for their price target over the next 12 months, not too far off the intrinsic value we've calculated. They see upside of 17%. Again, similar to PCOM, they do see this as a strong buy now. Now, before we head to the next stock, just to let you know, we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, click on that pinned comment below to sign up and you will have instant access. The third company we're looking at today is Medtronic PLC. Now, they're up around 10% over the last year. Over the last 10 years, as we can see, similar to the previous company, it did hit its all-time high, $135, around 2 to 3 years ago. Now, in terms of the 52-week range, it is in the mid to upper end of that spectrum. We do see the forward yield of 3.23% and the forward PE 16.46. Now, in terms of dividend safety, the highest score obtainable at 99, very safe. Market cap 114 billion, a mega cap company. Now, when we look at those essential metrics for the last recession, well, they increased the dividend. They had plus 0.6 sales, but they did have a near S&P return at negative 56. Dividend growth, very poor in my opinion, last May at 1.5%, well below the minimum 4% I target, but over the last 5 years and last 20 years, we do see some very strong dividend growth, so hopefully this was just a one-off for Medtronic. We also note they are a dividend aristocrat. They have increased those dividends for the last 45 years, and in fact, they're about 5 years away from becoming a dividend king. Again, similar to the other stocks we've reviewed, we do have that double sign of undervaluation, a pretty strong starting yield at 3.21 when you look over the last 5 years, and we see the forward PE 16, it is still below that 5-year 18.1. We do note, however, it isn't too far off the healthcare sector PE at 17.4. In terms of the free cash flow payout, well, it did get a little bit too high in 2023 at 79%, especially when we have that 60% blanket rule. But 2024, we are expecting it to come under that to 56%, and that is one of the reasons why we do see that very safe dividend score. In terms of the free cash flow growth, pretty inconsistent, 455 in 2014, 344 in 2023, although positive to report that 2024, they are expecting that to hit 492. Now, when we take a look at the sales growth, we do see very mixed over the last 10 years. Now, 2022, 5%, that is in the range that we look for steady moderate growth of 3 to 7%. But we do note in the more recent year, 2023, a negative 1% hit to the top line. Again, more positively for the 2024 outlook, we are expecting, based on the trailing 12 months, around 5% increase to their revenue. Now, in terms of the numbers, 17 billion to 31.2. Now, similar to the previous company, we do see they have issued shares over the last 10 years. The net position here, however, is essential share dilution, increasing it from 1.01 billion to 1.33. In terms of ROIC, nice to note, it is around that 8% or more that we look for this industry. 7% for the last 3 of the 4 years, 9% in 2022, around that expected over the trailing 12 months at 8%. Operating margin, free cash flow margin, happy to report very strong, above the 12% on the operating side, although we do see it has come down from 2014, currently at 18%. The same can be said for the free cash flow margin, but what we do note, 15% is still looking very strong for the free cash flow for Medtronic. Now, looking at the net debt to EBITDA, we can see it has come down from the very high 3.16 in 2015. We do note 1.82 in 2023 and expected to come down even lower in 2024. Again, no real red flags with this in terms of that dividend safety, and the balance sheet based on this overview is looking very healthy. So in terms of the valuation, and don't forget you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, those on your watch list, or even if you want to run through these companies based on your own estimates and judgments. Margin of safety of 10%, we see a buy up to $99. At 15%, a buy up to $94. At 20%, not too far off the current trading price, but not quite a 25% margin of safety. So for today's episode of MDT, we see around a 20 to 25% MOS level. Wall Street, on the other hand, however, they are seeing some nice upside of 14%. Their price target lower than the intrinsic value, but they do set that around $98 over the next 12 months, indicating again this is a buy. But again, let us know your thoughts whether or not so far PCOM, Chevron Corporation or Medtronic are companies you have been adding either to your watch list or to your portfolio. We then move on to a company called DUK, Duke Energy Corporation. Now pretty flat over the last year. Over the last 10 years, however, you would be up 35%. We can see they're in the mid to upper end of the 52-week range with a yield of over 4% and a forward PE just over 16. In terms of dividend safety, a nice healthy score of 80 indicating its safety. Market cap 74 billion, a large cap company. Now, in terms of those recessionary metrics, well, they increased the dividend, they had above average growth, but they also outperformed the S&P with their negative 34% return. Now, what we do note here, they do continually offer those dividend increases, which are below that 4%. You could argue when interest rates were very, very low, this may have been a little bit more attractive, but important to note right now and over the last 5 years on average, that 2% level is a little bit less attractive than what we would typically like to see. They have been increasing those dividends, however, for the last 16 years. In terms of dividend yield theory, well, again, a double undervaluation signal, 4.31 versus that 5-year average, and we can see that forward PE is significantly lower than the 5-year of 18. When we look at the utilities, however, sector PE, the numbers aren't too far off each other. So in terms of the payout, let's take a look. And for utilities, just to let you know, they are a lot more volatile in terms of the free cash flow. So we draw your attention to the earnings below 75%, and what we can see pretty consistent, which is what you would expect from a utilities company. Although we do know 2024 is expected to drop to 69%. So hopefully we can see in their next increase at least a bare minimum inflationary rise. In terms of the earnings per share, again, this is what you do expect with these utilities. The consistency, 455, 556 in the latest year, expected to go higher again in 2024. So this could be useful for someone who does like stability in their portfolio. In terms of sales growth, remember 3 to 7%, pretty inconsistent, but when you look at it on average, they do hit that 3 to 7% that we target. The more recent year coming in at 1%, and again, the numbers saying 22 billion to 28.6 in 2023. Now, again, this is something that is fairly often we see on the utilities. They do rely on issuing equity, so diluting your position as a shareholder to fund their growth expenditures. So we can see it has increased from 707 million in 2014 to 771. Finally, then the ROIC. For utilities, we do want that 7.5% plus. We do see they do slightly struggle on that, with around 5 to 6% year on year. Something worth noting and possibly incorporating when you do use that MOS for your risk profile. Operating margin healthy, well above the 18 consistently year on year, 25% in 2023, looking very solid. So nothing to report. And in fact, the only real thing that we would say is a little bit of a downer, other than the fact that we do see their dividends increasing below that 4%, is their net debt to EBITDA. It is above that 5.5 that we want to see continuously, hence why we don't see a very safe dividend score. Although in positive news, 2024, we are expecting it to come a lot closer, 5.75 to that level we want to see for the industry. Now, in terms of taking a look at this intrinsic value, don't forget, if you do enjoy the episode, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So let's look at the MOS level. Now we have a intrinsic value of $105. At 10%, again, a few cents shy. So for Duke Energy, what we do indicate as a fairly reliable company, as we saw in the metrics, a 10% MOS level. Now, in terms of Wall Street and their price forecast, well, they see the price going to $104 over the next 12 months. So with this company, you have a yield above 4%. You have around a 10% margin of safety with 10% upside over the next 12 months. As always, though, do let me know your thoughts in the comments below. Are you adding any of these? We had PCOM, we had Chevron Corporation, Medtronic, and finally Duke Energy. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.